This is a special edition of Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Ambramowicz. Bloomberg Surveillance, the Fed decides.
Live on Bloomberg TV and radio. Good afternoon. Good afternoon. Counting you down to another Fed rate decision and Chairman Powell news conference alongside, drumroll, Lisa Ambramowicz, Jonathan Ferro, TK back in a hot seat from New York City with about 28 minutes to go, TK, until that Fed decision. What are you looking for?
What am I looking for? I think it's John and Lisa decide. I mean, that's what we're going to call the show today. What I'm going to look for is it's a changed script since about 10 a.m. this morning. We saw some economic data about a bank surprise. Lisa, before we went on air, was talking about the joy here in NYCB, and I got a real rate that's on jump condition move towards Priya Misra thinks we're going.
I have to say, TK, New York Community Bank was not on my bingo card for Fed decision day, but Bramo, that seems to be driving this market going into this call.
What's interesting is there's this community bank that bought some of the assets of Signature Bank. We can go into all of the details. Bottom line is this. A lot of regional banks have come on show after show, said we're healthy. Then suddenly you get one company coming out saying that they've got a loss and they're going to cut the dividend. And suddenly people are pricing in with greater certainty a rate cut in March.
And these are the moves you've got in the bond market. Let's get straight to it. Treasury shaping up as follows. We're down 10 basis points on a 2-year. On a 10-year, yields are lower by 7 basis points. Tom, 3.95 on a 10-year now.
Yeah, right through. I mean, and again, it was a velocity here. The ECI showed a little bit of that wage growth maybe coming off today, but then the banking shock and the bond market sets us up where there's ever more importance here. Not so much a statement, but this press conference today under a 4% 10-year yield has a new importance.
It raises the question, Tom, the stress for one particular bank, Lisa, a reason to buy this bond market or an excuse?
Maybe it's an excuse for the Fed to cut rates because that might be what they want to do anyway. And I think that might be what people are leaning into. As far as whether it's an excuse or a reason, I would suggest maybe it's an excuse based on some of what we've heard. That said, still a lot of concerns about commercial real estate. We are going to get someone better than I speaking about this coming up. JP Morgan's Priya Misra, as well as Deutsche Bank's Matt Lazzetti. They will be taking us up to the rate decision at 2 p.m. Eastern. Then immediate reaction from former Fed Vice Chair Richard Clarida, KPMG's Diane Swank, PGIM's Robert Tipp, and Bank of America's Michael Gapin. And finally, this is the main show, right? It's the Chair Powell's news conference, and we're going to talk all about the nuances and what he actually said with former New York Fed President Bill Dudley and BlackRock's Jeff Rosenberg. A fantastic lineup for something that people don't expect a lot, but this got a whole lot more interesting with New York Community Bank.
Fantastic post-game show, great pre-game show as well. Let's kick it off with Priya Misra of JP Morgan Asset Management. Sometimes the guests ask the best questions themselves. Priya, you've done that. How outdated is the December dot plot? That's a question you've asked. How outdated is it?
You know, I would argue it is a little outdated. Inflation has continued to decline. You look at the labor market, ECI today. So I think what the Fed might have hoped in December that inflation continues to head lower, well, it has continued to decline. And I would argue parts of the labor market is also sort of moderating. So I would argue when they talked about 3 cuts in December, well, maybe the new dot plot, if they were, and they're not putting out a dot plot today, that number might be 4 or 5. I think the Fed needs to now clearly talk about normalizing policy, not easing. That's the switch I'll be watching for. They need to remove that tightening bias. So I think it is a little bit outdated, but let's see if Chair Powell goes that much. But at least talk about the fact that the Fed should be ready to normalize tapering of QT as well as on the rate cut front. To open that door, buy time, wait for data to sort of push them towards March or May.
The focus shifted earlier on this morning. This afternoon, all we're talking about is New York Community Bank. Priya, with that in mind, do you think that's a good reason to buy this bond market today or just a good excuse?
I think it's an excuse. I mean, the whole regional bank issue just tells you the lags. Remember, we talked about the lags for the last 2 years. I mean, it takes a while. There was a lock-in effect. Interest rates matter, but they just matter very differently for different parts of the economy. I would argue banks are extremely interest sensitive. The housing market is interest sensitive. This is another format of banks that may have required capital. They got funding. They didn't get enough capital. But the broader problem, the issue that I think the Fed and we're all facing is monetary policy restrictive. And I would say, yes, it is restrictive. And that's what the Fed needs to start paring back some of that restrictiveness. But they're going to go back to their dual mandate. Look at where inflation is, 3-month, 6-month, 9-month moving averages close to 2%. The employment situation looks good, but it's a very lagging indicator. So start that normalization. They have their soft landing. Keep that soft landing if they can start that normalization process.
Priya, you've got one of the arch calls on Wall Street. which is that the real yield falls way down to 1%. You're pretty lonely out there right now. What are the ramifications if we see the real yield continue today and breach through 1.60%? What does that signal to Powell and the rest?
So to me, real rates, particularly long-end real rates, is what is one measure of how restrictive monetary policy really is. And I think if our star estimates of real equilibrium rate is 50 basis points to 1%, we're well north of that. What that tells you is that there are residual pressures in the system that are slowing things down. And that's what the Fed might be looking. Now, you asked about ramifications. If they were to lower real rates sufficiently, get them close to 1%, it allows the soft landing to last. On bonds, I think, whether they get those real rates lower or not, we're getting significant inflows into bonds. As investors who've been sitting out in cash, the $6 trillion sitting in money market funds, they start to see the Fed starting to cut rates. That reinvestment risk starts to come back into their minds. That's a regret factor. They start to want to lock in these level of rates. So I think it's positive for bonds when the Fed starts to cut rates, because that money starts to move into bonds, and the correlation between bonds and stocks starts to come back, because a hard landing, bonds have a lot of more room to come down. So I think that real rate ultimately will drive how quickly different asset classes price, but it's how we get there. Does the Fed take us there, or does a hard landing take us there? I think that has different implications for risk assets.
Priya, I've spent the past 4 hours really thinking about New York Community Bank Corp significantly. And I've been looking at the exact issues that came up here. It looks like there are 2 loans that increased their loan loss provisions dramatically, and there's idiosyncratic issues. But there's a greater concern here that this is just the first shoe to drop, which is the reason why you saw such a broad market action. All things being equal, doesn't it kind of make it more likely the Fed will go in March just because they're looking for an excuse and they already see inflation coming in?
So even without New York Bank Corp, there's an argument for them to go in March. They've got inflation down to 2%. Wages are also telling them that wages, rent, inflation, all the leading indicators of inflation is telling them we're getting back to 2%, which means the real policy rate is actually going higher. If they don't do anything with Fed funds and inflation is lower, they're becoming more restrictive. The banking sector woes, where I think there are losses within the banking sector, within the broader economy, that high real interest rates impose. This is just another manifestation of that. We know we have the commercial real estate overhang, and I think that this would add to the argument for the Fed to cut rates. But even without that, I think start the process, go 25. I think Governor Waller's comments, go methodically, go carefully, cautiously, actually should suggest start in March, and then you can go 25, as opposed to wait until the second half of the year, and then they'll be going 50, 100, and the broader risk market will not know is that good news or bad news. I think it's much easier if you start earlier.
Priya, you've been constructive on risk assets, more constructive on credit as well. With everything you've just said, how big is that window now?
I think right now, before the Fed meeting, I would say you still have that window, because few things have happened which has made us positive on risk assets. The supply side kicked in, which is why inflation declined close to the Fed's target without resulting in a big rise in the unemployment rate. And the Fed, that despite saying higher for longer, suggests that they can start to normalize. Those 2 factors continue, and the Fed actually starts to normalize. I think you've got that window. I worry if they try to be too cute. I mean, between March, May, June, really, what's a few months among friends? Start the process, tell us, and I'm hoping that Mike Mickey or someone will ask the Fed today that you're starting at 5.5. So the reaction function should argue that, you're so high in real rates, you're so high in nominal rates, start the process. It becomes a lot harder when we get to 3% and 2.5%, should the Fed ease or not. But right now, we're coming off really lofty rate levels. So start it. And I think that path will become a lot narrower if the Fed tries to become really cute and says, oh, let's figure out the precise time to start to cut rates. I think just start.
We'll get that message to Mike McKee in about 20 minutes' time. Don't worry. Priya, you're going to stick with us. Priya Misra there of JP Morgan Asset Management. Lisa, how many times have we talked about this? Not all rate cuts are created equally. If you're cutting interest rates because banks are struggling, that's very different to cutting interest rates because inflation is coming down nicely towards target.
Which is a reason why you saw bonds rally and stocks sell off. Just on the margins, but still, you saw that reaction function shift in response to concern about stress once again in commercial real estate in some of the smaller banks.
TK, stocks lower by 0.75%.
Yeah, stocks are lower here. Microsoft had a terrible day yesterday, not making any money. In America, it's a boom economy. It's a highly unusual meeting, John, and to Priya's brilliance there, to me, it's extraordinary here, the importance of getting this process started.
The conversation continues. The decision about 17 minutes away. Up next, Matt Lazzetti of Deutsche Bank, and later, former Fed Vice Chair Richard Clarida.
Watching the Fed. We know that the Fed isn't going to do anything.
I don't think the Fed's going to move this month.
The Fed's in a really tricky spot.
It's a very, very tight rope.
Officials will more clearly outline how they're thinking about rate cuts over the next year.
They'll move to a more kind of balanced language.
We're going to hear Powell more in this careful camp.
Probably going to maybe pull back a little bit in terms of the expectations that is already in the market about March.
Going to be essentially validating at least some of what markets are pricing in.
Open a door, but basically tell us it hasn't decided when it's going to walk through it.
He's going to say that there's been progress.
If you look at the amount of progress you've had on inflation, it's been really substantial.
The Fed can take some credit for that and some comfort in that.
Today is the best day ever for the Fed and Jay Powell to walk in and give a 30-second press conference.
The Fed has been reluctant to wave the victory flag, but maybe they'll start to raise it and let it blow a little bit in the tailwinds of the economy.
The Fed decides. The decision 15 minutes away. Here's the price action on equities this afternoon. In the equity market on the S&P 500, lower by almost 0.75%, down by more than 1% on the Nasdaq. Disappointing lofty expectations, tech earnings yesterday afternoon, and then a struggle for New York Community Bank. Difficult numbers for them. That stock is down and down hard. In the bond market, it means this: a 2-year, 10-year, 30-year getting bought. Yields are lower by 6 basis points, 396.72 on a 10-year. The last time the Federal Reserve met, Lisa, the 10-year closed that day in the middle of December at 4.0164%. I don't think we've closed below 4% on a 10-year in more than 2 weeks.
And we're talking about the potential for Fed Chair Jay Powell to push back or not. He could lean in and he could basically say, look, it looks like the market understands where we're going with this, and give a nod to some sort of March rate or just some rate cuts coming in the near future and not really talk about a bias to any kind of tightening.
Tom, just to finish on where the 2-year is, we're down about 9 basis points. The 2-year, 4.25.
I like the 9 basis points move, and it's very much a 2-year thing. You see it in the 2-10 spread and also in the real yield, John. To frame that out, we're at 182 2 cups of Tang ago, and we've come into 1.72, and we were talking to Priya Misra of the ramifications of a 1.59. That 1.59 10-year real yield is unimaginable to the people playing the parlor game.
Tom, I think Priya's speaking to the conversation that a lot of people on the street are having right now. If you want to open the door to interest rate cuts, why don't you get going now? Given the political calendar as well, and not just where the economy is moving to.
It is, and I said this yesterday, and I think they're all slaves to what Greenspan codified, which is this idea of measured, and we need to be measured. We need to be careful. He wasn't careful in his academics at UCLA, and this is a really important conversation on ambiguity. Ambiguity is a strange economics word, and that's where Jerome Powell is right now on what he's going to do about the nominal 10-year yield. Matthew Lazzetti joins, Chief U.S. Economist at Deutsche Bank. To me, the entire exercise, Matt, is ambiguous. I got a boom economy. I got a yield up there before the bank uproar this morning. And at the same time, people are begging for the yield to come down. How will that play out this year? Within our ambiguity, which way will we go?
Yeah, I think no doubt. We think the Fed is cutting rates this year. We think they're going to be cutting rates pretty meaningfully, certainly in the beginning in the first half of the year. The key question for today, though, is how much does Chair Powell signal that that's likely to come at the March meeting or not? I think that's really the only key question from the market's perspective. I think he does keep that ambiguity there. I think he keeps that door open that they are entering a period here where they will be cutting rates, but does not send a clear signal that they're going to come, the first rate cut is likely to come at the March meeting. I think very clearly they're highly data dependent. We get a lot of inflation data between now and then. And if you get inflation data that continues to support the idea that it's coming down, substantial disinflation, they can cut rates, certainly then they can walk through that door at the March meeting.
Matt, you and I have talked about this phrase, passive tightening. What is passive tightening? And is it something they try and address in the news conference today?
I think no doubt, how they've been laying out why they're going to be cutting rates under a soft landing scenario. It is a concern that as inflation comes down, that real rates rise too much and that it could put the soft landing in jeopardy. I think it has a really nice tie-in to the events of today. We're coming from an economy that looks very resilient, strong growth, labor market is strong, consumer spending is strong. But at the same time, there are risks out there. If interest rates remain elevated and higher for longer, it does suggest that those risks could manifest. It could put the soft landing in jeopardy. And, so certainly at the margin, the events of today do argue for adding some probabilities to rate cuts as early as March.
This actually is exactly where I wanted to go back. This idea that New York Community Bank Corp could single-handedly tip the scales for the Federal Reserve. Do you think that this is exactly the narrative shift that they've been looking for because they've been looking for an excuse to cut anyway?
No, I don't think they want to see banking stresses as an excuse to cut rates. I think they'd be quite happy to cut rates simply because inflation's coming down, and they can allow kind of allow that to play out and to support the soft landing. But it does make the decisions clearer. It's a little bit more ambiguous or more difficult in an economy growing above 3% with a 3.7% unemployment rate and consumer being robust. There's kind of key arguments on both sides. If you do see some of these stresses emerge, it does make the decisions easier.
Can they paint this as something of a positive for the economy, as passive tightening, if they use some of the stresses that they're seeing in specific places as a reason for their caution and their potential actions?
I don't think you will hear Chair Powell, highlight, the banking sector stresses. I think they will continue to think about it as sound and resilient. I think internally, as they're thinking about those discussions and decisions, it just gives them, some caution, and it does indicate that there are still risks out there, and that they can help to, I think, solidify the soft landing by beginning to bring down rates. As they, publicly talk about why they're cutting rates, I think it is all about inflation coming down. It's all about ensuring that policy does not become too tight over time. And it's all about solidifying the soft landing that looks to have really grown over the past several months.
Priya Misra is still with us from JP Morgan Asset Management. Priya, just how mechanical is this? As inflation starts to come down, how concerned should they be about so-called passive tightening?
I think they should. I think academic models, et cetera, all argue real rates is ultimately what impacts the economy. It's just a hard one to explain to everyone, to the market. So I think that's why Chair Powell, I think that's the focus of the press conference today, to explain that passive tightening, to talk about what does real interest rate mean, why is it that important, and then to talk about how restrictive monetary policy is. I think they've suggested that it's well into restrictive territory. We need a more definitive answer. They need to remove that tightening bias from the statement. Say policy is restrictive. We don't want it getting more restrictive. Let's just start the normalization process. I think that's an easier way to message the passive tightening than go into real rates. I know as much as you all love real rates.
Well, the real rates are great, but the answer is our audiences on radio and television are dealing in the real economy here right now. Dovetail this, Priya Misra, with the work of Michael Ferroli and Bruce Kasman and the basic idea of the IMF the other day with 1 year, 2 years, 3 years of what any and all Americans, including Biden and Trump, would say is subpar GDP. How many cuts do they have to come down just to catch up with what the IMF's modeling out?
Great question, because as much as we're all focused on March or May or June, it's the total amount of cuts that the yield curve is sort of discounting. And we're pricing in the endpoint after the cuts at 3.25. That's still north of what the Fed argues neutral is, which is 2.5. So I think it's about the total amount of cuts. In a soft landing, 200, 250 basis points of cuts are completely reasonable. So there's more room for 5-year treasuries to decline or real rates to decline, even in a soft landing. In a hard landing, they have to go into accommodative territory. That's 2%, 1% Fed funds. I think just having those two scenarios in mind can sort of guide or put guardrails around where interest rates should go. But I think we're talking at least 200 or 250, even in a benign growth environment, which is what the IMF is projecting now.
Matt Lazzetti, I know we've got a few more minutes left with you. Can we just get into the details of the statement before it comes out in about 7 minutes? In the third paragraph of the statement back in the middle of December, there's this line about the committee determining the extent of any additional policy firming that may be appropriate to return inflation to 2%. Just still implicit in that is this bias to tighten maybe a little bit more if they need to. Does that get dropped today, Matt?
You're right. That's exactly where we should be focused within the statement. It's the key. We do think it gets dropped. We think that they drop the explicit tightening bias. They go to something more generic, kind of talking about policy adjustments, which kind of hints that they could go in either direction. But really, I think that is the precondition. Dropping that language, dropping the explicit tightening bias is the precondition to open up rate cuts as early as the March meeting. And that'll be the focus, I think, at 2 p.m. Do they drop that or not? And we think they do.
Hey, Matt, we'll look out for that in 6 minutes' time. I know you've got to run. Matt Lazzetti there of Deutsche Bank. Priya, we can continue that conversation. Would you look for the same change? And will that set up a bigger conversation in the news conference about pulling back QT?
Absolutely. And I hope he's asked about QT as well, because, Dallas Fed president brought it up. Maybe they need to start tapering QT. They're trying to finesse the level of the balance sheet, and they're getting close to low levels on RRP. So I think this whole idea of normalization, if the Fed opens the door, they remove the tightening bias. And then I think asked about whether dot plot had 3 cuts. What would be the baseline today? And Chair Powell's not going to answer that. But then to try and get a sense of if they were to start, is it at 25 basis points? Is it in line with tapering QT? I think just trying to understand the reaction function on the balance sheet and rates and at different levels, right? I think at 5.5, it's easier for them to start to cut and becomes a little harder as they get those rates down closer to 3%. But I think that's going to be the focus, just trying to understand that reaction function today.
Priya, it's off your remit, but we saw ECI finally lighten up a little bit today. We got a jobs report coming up on Friday. Where are we going to be Monday morning?
There's a lot this week. It's a very big macro week. But I think the jobs report will be an important number, both the average hourly earnings and the number, to get a sense of, is the labor market slowing? I would say the labor market tends to be often a lagging indicator. So if policy is restrictive, we think things are slowing. Whether it shows up, it's a noisy number. Whether it shows up on Friday or not is harder to tell. But I think, what's the message from the Fed today? Are they open to normalizing policy, starting the process of normalization? How is the economic data? What's the fallout of New York Community Bank? Is that one bank that needs capital? Or are there these problems across the regional banking system that the market starts to fret about? We've got this new wrinkle, which is actually not such a new wrinkle given what we lived through last year. And remember, the BTFP program runs off. So this cheap funding that banks had runs off in the middle of March. And so does the discount window start to get used? So there's a lot. Come Monday morning, we'll be looking at the banking sector, the economy, and then trying to assess, is the market pricing in the correct Fed reaction function?
Well, Priya, I'm glad that Tom went there to all of the things that can happen, because we've been seeing just narrative shift after narrative shift. And earlier this morning, we had several guests on who are talking about how the biggest risk is actually a reacceleration of inflation later this year, whether it's Wei Li of BlackRock or whether it's Sebastian Page of T. Rowe Price. All of them have the same fear. What are you seeing that makes that less relevant if people are looking at the strength in every single outlet, regardless of, yes, one pocket? What are you seeing that gives you confidence that we should focus more on New York Community Bank Corp, more on certain weakness and some peripheral indicators?
So maybe it comes from my thesis that monetary policy is restrictive, because I look at long and real rates. I look at the fact that the balance sheet is shrinking. So, we talk about easing financial conditions, but it should be viewed, it's context dependent. It should be viewed relative to where the economy is. If inflation's at 2%, yes, financial conditions have eased, but they haven't eased to the point where they start to become accommodative. If we were in accommodative territory, absolutely, there's reacceleration of inflation risk. I think we went from very tight financial conditions to less tight financial conditions. Monetary policy is still very restrictive. So where does that inflation reacceleration come in? Now, I'm watching wages. I was nervous before ECI because it's been running higher than average hourly earnings. And if that number had come in 1.2 quarter over quarter increase, okay, then it's a little nerve-wracking because our wages not coming off. Wages are coming off, rents are coming off. A lot of the higher goods inflation is already in deflation. So when I look at service inflation, I don't see signs of that reacceleration unless the Fed goes crazy and goes to like 1% in the near term, which is unlikely. They're cutting slowly, methodically. So we really need easy conditions, I think, for that reacceleration. I don't see those easy conditions here.
Hey, Priya, great to catch up with you. Priya Misra of JP Morgan Asset Management, 2 minutes out from that Fed decision. It's interesting the way we started the conversation this morning and how it's developed as we've approached this decision. The conversations we had this morning, Bramo, Chair Powell's going to be non-committal in this news conference. What we heard from Matt Lazzetti at Deutsche Bank is that they've got to set this up in the statement and then in a news conference going into March and maybe beyond.
And people earlier this morning were saying maybe that's going to be a mistake because there is this strength that could cause inflation to reaccelerate. Now people are saying, get on it. Why don't you cut now? Because basically you're getting a green light with signs of things being pretty tight.
I think the green light here is the markets are on the move. To have Priya here on the Fed decides is really key to get up front. I wish she was in the press conference asking her own questions. I got a 171 10-year real yield. That was unimaginable, John. 24 hours ago.
We'll catch up with Mike McKee in 60 seconds. 60 seconds away from that decision from the Federal Reserve. Here's the state of play in financial markets at the moment. In the equity market this afternoon on the S&P 500, we are lower by 0.7%. On the Nasdaq, we're down by 1.1. I did not think we'd be talking about New York Community Bank and the bond market today, but we are. Lisa, Treasury yields lower by 10 basis points at the front end to 4.24.
And how many people have said community banks are fine, they're successful, they're not going to fail, they're not going to show cracks. New York Community Bank comes out and has a loss and suddenly cut rates sooner because that's basically a sign the stresses are getting too great.
Just shows that people are still on edge about this issue.
100%. I think people have not realized whether you've seen the shoe to drop, and commercial real estate still a very big question mark, particularly in certain urban centers.
The 10-year yield down by 7 basis points, 395.77. Just to finish on foreign exchange, the euro looks a little something like this against the dollar. Euro dollar at the moment, 108.47, totally unchanged. With your Federal Reserve decision, here is Mike McKee.
Risks to the economy are now balanced, the Fed says, and they're no longer talking about raising rates, but do not expect cuts soon. No change in rates today, and the statement drops the reference to additional policy firming, now saying, quote, in considering any adjustments to the target range, the committee will carefully assess incoming data, the evolving outlook, and the balance of risks. But before you buy March futures, the statement goes on to say, the committee does not expect it will be appropriate to reduce the target range until it has gained greater confidence that inflation is moving sustainably toward 2%. Officials say the economy is solid, job gains remain strong, and the committee judges that risks to achieving its employment and inflation goals are moving into better balance. Inflation, however, has eased over the past year but remains elevated, the statement says. The economic outlook is uncertain, and the committee remains highly attentive to inflation risks. There's no change to balance sheet policy, nor does the statement suggest any changes are imminent. The Fed will keep the $60 billion cap on Treasury roll-offs and the $35 billion cap on mortgage bonds. The decision today, unanimous. And one other bit of business, the Fed has extended its tighter policies on investment and trading to senior staff and any staff with access to confidential information.
Mike McKee, thank you, sir. Let's get to the price action immediately and look at equities. Equities on the S&P 500 just a touch lower by almost 1% on the S&P. On the Nasdaq, we're down by 1.4. If you just turn to the bond market briefly, yields were lower by about 10 basis points to the front end. Now 425.61. That move fades just a little bit. So, Lisa, let's go through what we got here. We've dropped the tightening bias, but not a full embrace of the rate cut conversation taking place on Wall Street.
And there's a little bit of disappointment, clearly, that you can see on the front end with people maybe thinking they would lean into a March rate cut, saying not thinking anytime soon, highly attentive to inflation risks. That focus may be casting a bit of cold water on some of the hopes and dreams.
The TK down 5 basis points on the 10-year, just short of 4% here at about 3.98.
Coming a little move here, John. And I still say we're radically different from where we were earlier this morning or even days ago. Yes, we've pulled back a little bit. It'll be interesting to see the press conference, to say the least. This is well-timed. Joining us now is Richard Clarida. He is with PIMCO, their global economic advisor. He's the former vice chair of the Fed and far more associated forever with his Columbia University. Richard Clarida, Ethan Harris, student of Columbia, ex-Bank of America, wrote a brilliant piece off his hero at Columbia, Phil Kagan, the other day, and he said, we've blown it on our inflation studies. We've got to get on trend. And for him, the trend is the Dallas Trim Mean, the Cleveland Median, and the rest of it. What is the trend right now, Professor Clarida, in inflation?
Well, thank you for having me on, Tom. Good friend of Ethan, and Phil Kagan was a colleague and a friend for many years. I look at Dallas Fed trimmed mean 2. It's running somewhere in the mid-2s on inflation. That's down a lot from a couple of years ago, but still obviously somewhat above the Fed's long-run goal of 2%. But I think that's a good reading right now.
Rich, when you look at the pushback, and it is subtle pushback in this statement, why do you think this Federal Reserve is not quite prepared to fully embrace that rate cut conversation taking place on Wall Street?
Well, on this one, John, I actually agree with them. I myself, looking at the data they're looking at, would have thought March would be too soon. We don't get a lot more data in March than we have today. Moreover, as you've pointed out on air, and I've been watching, there is still some upside risk on the inflation picture. So I just think good policy prudence would call for getting more information. And I applaud what they did in the statement today. They did. I don't have it in front of me. I read Mike's account. Looks like there's a lot of red ink in it, and I think that made sense today.
Yeah, especially with that particular comment. The committee does not expect it will be appropriate to reduce the target rate until it has gained greater confidence that inflation is moving sustainably toward 2%. I'm wondering, Rich, do you think that the New York Community Bank Corp issue changes the equation, even on the margins for the Fed, and if you were on the Fed, for you?
Given what I know right now, Lisa, I would say not, but I do think that the reality is that we have a number of regional banks in the U.S. Above 100 billion, but not in that mega category. And the Fed did what it needed to do last spring, and I have no doubt that they will be there if further is needed. So I'd say right now, this doesn't appear to me to be systemic, but whenever banking is involved and you see an unexpected loss, it certainly is on their radar, and I'm sure it is.
Rich, as you know, as we know, a lot of thought goes into the language that gets put in this statement. That line, greater confidence. A lot of people are going to stress test that line, greater confidence, for the next 1 month or so. Neil Dutter, our good friend over at Renaissance Macro, writes in, what exactly does greater confidence mean? Can you talk to us about that, Rich? What do you think greater confidence means? And I'm going to ask this question just to wind up TK. Is it 1 CPI print? Is it 2? Is it 3? Rich, what is it?
Well, I think, at the risk of exaggeration, you might have 19 opinions on that on the committee. I think the center of gravity, though, look, the price inflation numbers have been moving in a very good direction. 6 months now, core inflation or Dallas Fed measures are definitely close to 2%. But we do have an economy in which wage inflation is running about a point hotter than probably they think would be consistent with the long-run goal. So I think implicitly they'll be looking at a number of indicators from the labor market. We got some good news today on ECI, but even with that, ECI is still probably about a point hotter than they would ultimately like to see.
Rich Clarida, measured. I'm going to associate it with Alan Greenspan. You may want to take it back further. But I'm sorry, we are slaves to measured, and our great fear of becoming unanchored. We have regret. We're worried about the Bank of Japan. I believe it was back in the early 2000s. We need to be measured. How do we be measured after this pandemic and after this original economics?
Not surprisingly, good question there, because measured was used by the maestro in 04 to talk about a measured pace of rate increases, but certainly now it may enter the conversation once they start to cut. And I think here you do see the tug of war. Folks look at past history. They see that when the Fed starts to cut, it cuts very fast and in big chunks oftentimes. Typically, if you go back and look, Tom, in soft landings, and what turn out to be soft landings, it looks a lot different, more like 2 or 3 cuts, 75 basis points or so. So I think a lot of the measured in this cycle on the down direction is going to depend upon how soft the landing is. Jay Powell thinks the runway for a soft landing's in sight, but right now that's a forecast. So it will be data dependent. Sorry, that's a cop-out, but I do think that it will be data dependent.
Can the Fed afford to be measured?
Like a Fed official.
Well, I mean, can the Fed afford to be measured and start later if we're also bumping up against a political silly season, as Tom would say? This has become something that more and more economists are looking at. Why not start earlier, go more slowly, and be less susceptible to becoming a political football?
Yeah. Great point. It is an election year. I noticed historically, and you can confirm this on your Bloomberg terminal, historically, the Fed has moved in election years in both up and down. So I think the Powell Fed will do what it needs to do. this year in terms of adjusting rates, presumably downward. But I do agree with you, Lisa. You know, if you think you're going to cut 3 times, say, which was what the December SEP was, certainly it would make sense to get that process going, you know, perhaps in the summer and not wait till November, shall we say.
To dovetail with the academics of Richard Clarida joining us now from the Midwest, Diane Swank of Michigan, Chief Economist, KPMG. Really pleased to have you here with Diane. Let me get away from the monetary mumbo jumbo, Diane. You are expert on the pulse of corporate America, on this technology overlay we've witnessed. Look at the profits of Microsoft yesterday, and also on this new change in productivity. Does this Federal Reserve have any understanding of the new productive America?
I think they do. I think they're watching it very carefully. What the question is it something that's sustainable? And, you know, this is why I agree 100% with Rich, the measured concept, because I think the markets really want to see much more aggressive rate cuts, and the Fed, I think they start in May, but I think what's important about it is they start before the second half of the year, before we really get into the summer, and I think that's going to be justifiable. But I really think it's important to understand what's going on in terms of productivity growth picked up in part because people are not quitting jobs as much. They're learning the jobs they had. We're also finally leveraging all that technology that we took on as we pivoted online. That's all good news. The question is, how sustainable is it? And I think that's something the Fed still hasn't figured out, and that's what we're going to see in the minutes. I mean, it's really interesting to me that the December meeting, when Powell came out and had a much more dovish tone and was pretty excited, and markets got pretty excited off of his comments, the actual minutes to the meeting were that, you know, hey, we're worried that inflation risks are to the upside. And so it'll be really interesting to see the minutes off this meeting in terms of how they see the productivity growth continuing in 2024. And, you know, it's a cop-out. The Fed gets to be able to react and be data dependent, and Rich is absolutely right about that. But that's what they're going to do. They're looking at a meeting-by-meeting basis. And I think, you know, we'll have enough information by May and June to begin those cuts. But I think that measured side of it is also really important because the markets really want to take off and put a lot more cuts in than the Fed is really willing to do.
It was a really bizarre sequence to have the chairman engage in a conversation about interest rate cuts. Then New York Fed President John Williams come out and say, not really talking about rate cuts. And then the minutes seem to back up Williams and not Powell. Diane, we'll let it go. Let's see if they repeat it again. I think, Diane, today there's a feeling they are going to engage in a conversation a little bit more openly about the timing of interest rate reductions. Do you think they need to draw a clear distinction between adjusting rates and easing policy?
Yes, absolutely. And I'm sure Rich would agree with me. I mean, this is removing the restriction, but not trying to stimulate the economy. And I think that's very important. They're trying to normalize rates. They're not trying to stimulate a moribund economy. And that's a very different scenario, as Rich pointed out, from a soft landing and what may be, at the moment, an extremely soft landing. We also know that, you know, we're kind of coming in really strong in the first quarter on consumer spending. Even with January and some weather disruptions, you don't need much consumer spending for it to be very robust in the first quarter. And that's something the Fed's very attentive to right now as well.
So in the press conference, most certainly, Rich, there's going to be someone who comes up and asks Fed Chair Jay Powell, so how much did you guys talk about rate cuts? Did you throw out dates? Did you throw out what your criteria are? If you were on the Fed, what would you hope he would say? How granular should they be, given the fact that people know they're talking about it? They have to be talking about it. Everybody else is talking about it. How much do they really telegraph to the market?
Sometimes, Lisa, when the press conference is, moving beyond what was in the statement, sometimes because the chair wants to move in that direction or because you've got a divided committee. I think today, and of course we'll find out in 2:30, I think today is a day when the chair on that question in particular will hug the FOMC statement pretty closely because it was a big change from December. Some of it was expected, some of it was a little bit more hawkish. And so knowing Jay Powell, I think today will be a day when he gets a question like that, he will hug the FOMC statement language pretty tightly.
That's what you do with Bramo questions. Just hold on to the statement, try and ignore the question. I just wonder how many times they shared the love letter from Senate Banking Committee Chair Sherrod Brown and the letter from Senator Elizabeth Warren and her Democratic colleagues. Rich, you've got experience of this under the Trump administration. It's often, and I'll say it for you, it was inappropriate then, it's inappropriate now. How did you deal with it then? How do you suspect this FOMC will deal with it now, as you see lines like this from senators down in Washington, D.C., that I urge the Federal Reserve to ease monetary policy early this year? How do you deal with that, Rich?
Obviously, we had to deal with it in a different context, but it goes way back. And I think Fed institutionally and Jay Powell individually understands the stakes. And I think he just thinks this is just part of the job, and the Fed will look through it. And of course, the data is breaking in a direction where that completely reinforces it.
Richard Clarida, though, this is a good time to mention, of course, this is your public service to the nation, is with John Snow in Treasury, Paul O'Neill, and your work, of course, as vice chair, recently anointed by the Museum of American Finance with the Whitehead Award. And I'm going to go back there to Paul Volcker and others. I'm sorry, Richard Clarida, at the end of the day, you were teaching Politics 101 at Columbia. This Fed has to go into an election cycle no one watching or listening has ever seen. How political does the Fed get, say, Labor Day?
I think the Powell Fed will not be political, but it's inevitable monetary policy will be pulled into the political presidential discussion. I think they're prepared for it, and I think they have decided, or they're deciding what they think they need to do based on the economics, and when they're ready to go, they'll communicate it. I'm confident they'll succeed, but I don't disagree that there's going to be enhanced emphasis and focus and a political element to the focus on this.
In the meantime, there's a real question, Diane, about what exactly greater confidence means, as John was talking about earlier. What metrics are you looking at? I was struck by doom spending, which of course caught my eye, but some of these areas that might be distorted because of changes post-pandemic. What gives you the clearest read?
Well, I think you're just going to have to continue on the labor market and inflation. Those are the two most important things. Those are the two most important data points to the Federal Reserve, and that's what they're going to be watching. I want to just echo something that, Rich said. We've seen Powell go through some pretty hard political times already, and he's proven himself to be an institutionalist with the Fed on that, and I think that's a positive thing. The Fed doesn't have a horse in this race. That said, they will be blamed for no matter what they do, no matter what, and they know that. And I think that's what Rich is telling you, and that's, that doesn't mean their decisions are going to be influenced by it. It just means that they know how to go through the hailstorm that's about to hit them. That said, they're looking for continued improvement in inflation and continued improvement in services inflation. I think they're going to get it. And I think they will be moving by May. But the bottom line is they want to see that continued improvement. And they're also watching the consumer out there pretty closely, because this has been a remarkable, not only resilient consumer, a defiant consumer, showing just how strong they really are.
Diane, Mike McKee is still listening. Before he goes into that news conference, questions for Chairman Powell. What are they now?
The biggest questions are, how do you talk about what is that exact issue is, what does this mean when you guys feel confident enough to cut rates? What is going to be the criteria? That's what all the focus is going to be on. And my guess is he's going to talk about it very vaguely, and that's the problem for financial markets, because they want something concrete. And this is when you get, and ask Rich about it, but you get to the hard part between monetary policy as a science or an art.
This is the art at the moment. Diane, thank you. Diane Swank there on the latest. Let's reset here. If you are just joining us live on TV and radio, it is a special edition of Bloomberg Surveillance, The Fed Decides. The news conference is in about 13 minutes' time. We had the decision about 17 minutes ago. No change on interest rates. They dropped this bias towards further tightening. There's this new line we need to talk about. The committee does not expect it will be appropriate to reduce the target range until it has gained greater confidence that inflation is moving sustainably towards 2%. So this is the market response to all of this. Your equity market this afternoon looks like this on the S&P 500, down by 0.9%. We're down 1.3 on the Nasdaq. Lisa, in the bond market, yields lower by 8 or 9 basis points. Not session lows on bond yields, I have to say. This move faded just a touch. So the market is looking at the Federal Reserve, hoping they inch towards interest rate cuts. They're kind of taking a baby step today, but not fully embracing the idea just yet.
The fact that they sort of said there's still a prolonged period of time before we reach our inflation targets cast some cold water. There still were people out there who thought maybe we'd get a cut at this meeting, right? That it was a live meeting. We heard some people saying that's what they should do, right? This casts some serious cold water on it. I love the idea of what we're going to hear from Jay Powell. Absolutely nothing. He will hug that statement. He will say as little as possible. He will be as ambiguous as possible. Just wait for it.
I think we could get a surprise like last time, and I think Diane Swank was absolutely right about the science and the art. John, we're coming out of a pandemic. The great missed call last year was economic growth. Where were we 12 months ago? Doom, gloom.
Totally, nailed it.
Total gloom. Everybody was wrong. I was wrong. Everybody else was wrong.
Lisa's taking this personally right now.
I know she is.
Tone it down.
You know, it's great in the new studio. The Bramo cam looks beautiful. But the point here, John, is it is an art. They're making it up as they go after this massive pandemic and massive stimulus. So I think today is less predictable because I was humbled last press conference.
Tom, it's important to pause here, and I'm pleased you've brought it up. It's important to pause and go over where we were, where we thought we'd be, and where we actually are. Where we are right now is unemployment sat at 4%. Inflation's doing better. Core PCE last week, we were talking about a 2 handle, not a 3, which is a massive change as well. And GDP, Tom, growth held up in the face of interest rates climbing aggressively. Now, this is not a judgment about where we're going. This is just an observation about where we are. And where we are is so much better than where we thought we'd be 12 months ago.
Greenspan 101, I mean, forget about measured. We have a stock market which is voting every day, every tick. And I believe since October has been on a tear. They have to fold that into the debate as
Just pulling back from all-time highs. Robert Tipp is with us of PGIM Fixed Income alongside the former Fed Vice Chair Richard Clarida. Robert Tipp, you've had about 20 minutes to go over this one. Your reaction to it?
Sure. Yeah. You know, where we are versus where we expected. I mean, we did not have a backdrop for a recession. Interest rates were raised for a reason. The system had a clean backdrop. It was not one of these backdrops that was going to crumble when interest rates were raised. It continued right through SVB. The economy has plowed through. And the Fed is fine-tuning the policy at this point. Now, they started off with the first notion of cutting rates. I mean, arguably back in July, Powell talked about how they would not wait for 2% inflation. They would be cutting way ahead of that. Now, September saw a huge U-turn, so they were fine-tuning with maybe like a chainsaw at that point. December, they came in and we had a U-turn, and a U-turn, frankly, before that in October, they called an audible as rates went up to 5%, and they started to talk down their own higher for longer. At this point, they're really balanced. The market wants to get 200 basis points ahead of them, which is actually kind of understandable. The 5.3% Fed funds rate they're running right now is a long way from the 2.5% that they're putting forward as neutral. And inflation is hundreds of basis points off its highs and pretty sustainably, is down in the 3s, if not down at target right now for about 6 months. So their comments, suggest they want to see a few more months, or maybe a big team of them want to see another 6 months before they go.
Robert, from the parlor game, let's go to what you and Greg Peters do every day, which you've got to be in the market. Are you being in the market, clipping the coupon, or can you actually still pop a good total return this year?
Yeah, I think big picture, the market is going to clip a good return. I think that your spread products, as we've said, starting off, put out a piece at the end of 2022, yield is destiny. You are going to clip that coupon. But we've seen the market 75, 100 basis points on either side of 4%, roughly. And I think we're going to continue to see these big swings. Right now, the market wants to go in the dovish direction. But this Powell Fed is aware that the second big move higher in inflation in the 70s came with hostilities in the Mideast, with volatility in the Middle East, and a big increase in oil prices. And we have full employment around the world. We've seen very high inflation that brought about higher wages. All of that is in retrograde right now. They're going to want to make sure they have that really under control before they turn aggressively here.
It's a good point, Robert, and I expect that we will hear from Fed Chair Jay Powell. They are watching the issues and the conflict in the Middle East carefully. Rich Clarida, one thing that was really notable about the December press conference was that Fed Chair Jay Powell had an opportunity to push back against that rosy outlook, the sort of flooding into risk assets that Robert Tipp was talking about and that so many people have embraced. He didn't push back. Do you think it's going to be the same at this press conference, that he will just say, ultimately, the markets will do what they want to do. We're watching something else, and we're on a good glide path?
Again, I think this is going to be a press conference where it will make sense for the chair to to really hug that FOMC statement. There was a lot of red ink. It was there for a reason. It gave the message that, basically trying to dissuade folks from pricing in that March adjustment and talk about they want to see the considerable and additional evidence. And so I think that's a pretty good place for him to spend most of the day, at least on those sorts of questions.
I have to say, Rich, you're not hyping up this news conference at all. It sounds like
Well,
Chairman Powell on repeat. I appreciate the honesty, though. Robert Tipp, just finally, I'm getting a load of people right in to say, what's the trade? What's your favourite trade right now, Robert, after what you've just heard?
Yeah, I think that it's not that whether the cuts priced in are correct or not. I think it's the timing and the shape of the curve. The ends of the curve, whether you're looking at the next 6 months or whether you're looking at the 10-year or the 30-year point, those look more reasonably priced than some of your 2-year out interest rates that are really banking on 200 basis points of interest rate cuts in the next 18 months. And I think if you can stay in the market and clip that coupon, avoid rolling up the yield curve, and also make some money on the tactics of trading this wide range on rates, I think it's going to be a very good year for bonds.
Robert Tipp, thank you, sir, from PGIM on the latest from the Federal Reserve. For more, here's Bank of America's Mike Gapin, the chief economist. Mike, you've got the Fed going in March. Do you like what you hear today? Are we making that closer step, another baby step towards your call?
We are. I think you can interpret the statement as saying risks to the outlook are balanced, therefore our guidance should be balanced. And then did we debate a rate cut today? Yes, we did, just not for very long. What we need is more confidence before we cut rates. And I do think that involves seeing more progress on services inflation and more progress on wages, because as you know, a lot of the disinflation has come from goods prices. Those declines may not persist. So the Fed will see more of that data. I think they can get there by March. So I'd say the statement was broadly in line with our thinking.
Michael Gapin, how aggregated are we or disaggregated? Are there two Americas out there, an America flat on its back, and then the prosperous Americas witnessed by Microsoft's profit yesterday?
Yeah, there is, the economy is bifurcated. I think more broadly, you could just say, industrials and goods versus services. The industrial side of the economy has been suffering. Regional banks, obviously, with news headlines this morning, still continue to struggle. But the consumer's in good shape. The services side of the economy is doing well. Tech earnings are doing well. It has been kind of a rolling recessionary story, where certain segments of the economy have had problems at different points in time, but the economy overall has powered through. So thinking about it in that way, Tom, I think makes a lot of sense.
Michael, I love hearing the bustle and the hustle behind you, and I imagine everybody saying the balance of risks. How do we get the greater confidence that inflation is coming down? What does that mean? So what do you think that means in terms of how much you've got to get in terms of data under belt?
So I think they can get there by March in the following way, in that they'll get February PCE, and they'll get the CPI and the PPI for that next PCE, I'm sorry, the January PCE, but then they'll get CPI and PPI for that February PCE print during the blackout period. So they'll have two more inflation reports. They'll get more information on where is services inflation, where is shelter. They'll get more wage data in the next two employment reports. I really think it's about that side of the ledger for some on the committee. For Governor Waller, he says the components don't matter. I just look at inflation. So his bar may be lower, but others are really kind of concerned about that good services trade-off and worry that services are too sticky.
In a word, optionality. It's written this way because it can mean whatever they want it to mean, Lisa, at any time over the next few months.
Which is the reason why he's going to hug that statement so close, and everyone's going to be happy. And then
Someday I'm going to read a statement or read the minutes, and it's going to say in there, "It is written." It's going to actually say it in there from Gaines.
Richard Clarida, let's come to you and just wind things up and put a bow on it if we can. This has been a single mandate central bank for the last couple of years, where they focus on inflation and getting it back down towards 2%. Can we talk about the other side of the dual mandate? Is there anything to worry about in the labour market from your perspective?
The labor market is in a very good place. If anything, it's running a little hot, but I do think there's a path for that to adjust under the outlook. So yeah, the labor market is, that's what we want, maximum employment. We're at perhaps a little bit more than maximum employment, but wage inflation is decelerating. We saw in the ECI, and I think that's what they're factoring in for this year, continuing that.
Michael Gapin, do you agree?
I do. I would say if concerns would be about the dispersion of employment growth, which is pretty narrow, focused in leisure and hospitality and education and health, and then remaining growth in the private sector is basically flat. But I agree with Rich. The labor market's in a good place, and it's helping to drive the outlook.
Mike, I know you've got to run. It's great to get your call. Michael Gapin there of Bank of America looking for a March interest rate reduction. Richard Clarida, thank you, sir. And congratulations on that Whitehead Award. Truly prestigious, sir. We appreciate your time. Let's round things up. Neil Dufter of Renaissance Macro writes in again. If they wanted to get rid of March, couldn't they have gotten something with some teeth, like we need a few meetings, as in plural, to establish confidence? This is weak sauce. This was tailored for me. This is weak sauce or tea in your case.
OK, look, they didn't want to give anything definitive. They don't want to give the market anything else because they want to maintain optionality. Basically, they want to be able to pivot on a dime if something comes up. And frankly, what we heard there from everyone is that each Fed member has a different view in terms of what the threshold is to have them vote for a cut.
I think I'm going to go back to it. I think Swank absolutely nailed it of science and art. Forget about the books. I was talking to somebody today about a textbook, John, from Central England called the Pentecost. Algebra, geometry, and certitude. There's no certitude here. There was a pandemic. And we're all good. The smartest chart I've seen in the last 2 weeks is Steve Ratner. He had it out at Morning Joe. And it was this great chart, John, of the shock recovery in employment. None of us guessed that. That's what they're dealing with.
Bruce Kasman of JP Morgan Asset Management, JP Morgan rather, a little bit earlier, I think absolutely nailed it. The door's open. And they've left it open today. It's up to them when they want to walk through it. We'll get revisions for inflation, a few more reads. We'll see where we are in March, Bramo. But at the moment, they want the optionality. Based on what they've written in the statement, they've got it, haven't they?
They don't have an upper hand, right? This is the thing. Everyone's debating where we are in the economic cycle. They don't know. So they want some sort of, smoke signal, and then they can go. But this isn't typically what markets like, because they definitely want something definitive rather than flipping and flopping and moving around the 10-year.
I would go back, and I'm not a fan of this linkage of politics into monetary ballet. But, John, I'm sorry. There's an election. It seems to be tumultuous. I think that's my briefing from Anne-Marie Horton. So the answer is they got to start in March to get out front of the politics.
I'd like to see questions about that. Entering the room, Chairman Powell on the first Fed News Conference of 2024.
Good afternoon. My colleagues and I remain squarely focused on our dual mandate to promote maximum employment and stable prices for the American people. The economy has made good progress toward our dual mandate objectives. Inflation has eased from its highs without a significant increase in unemployment. That's very good news. But inflation is still too high, ongoing progress in bringing it down is not assured, and the path forward is uncertain. I want to assure the American people that we are fully committed to returning inflation to our 2% goal. Restoring price stability is essential to achieve a sustained period of strong labor market conditions that benefit all. Today, the FOMC decided to leave our policy interest rate unchanged and to continue to reduce our securities holdings. Over the past 2 years, we have significantly tightened the stance of monetary policy. Our strong actions have moved our policy rate well into restrictive territory, and we've been seeing the effects on economic activity and inflation. As labor market tightness has eased and progress on inflation has continued, the risks to achieving our employment and inflation goals are moving into better balance. I will have more to say about monetary policy after briefly reviewing economic developments. Recent indicators suggest that economic activity has been expanding at a solid pace. GDP growth in the fourth quarter of last year came in at 3.3%. For 2023 as a whole, GDP expanded at 3.1%, bolstered by strong consumer demand as well as improving supply conditions. Activity in the housing sector was subdued over the past year, largely reflecting high mortgage rates. High interest rates also appear to have been weighing on business fixed investment. The labor market remains tight, but supply and demand conditions continue to come into better balance. Over the past 3 months, payroll job gains averaged 165,000 jobs per month, a pace that is well below that seen a year ago, but still strong. The unemployment rate remains low at 3.7%. Strong job creation has been accompanied by an increase in the supply of workers. The labor force participation rate has moved up on balance over the past year, particularly for individuals aged 25 to 54 years, and immigration has returned to pre-pandemic levels. Nominal wage growth has been easing and job vacancies have declined. Although the jobs to workers gap has narrowed, labor demand still exceeds the supply of available workers. Inflation has eased notably over the past year, but remains above our longer run goal of 2%. Total PCE prices rose 2.6% over the 12 months ending in December. Excluding the volatile food and energy categories, core PCE prices rose 2.9%. The lower inflation readings over the second half of last year are welcome, but we will need to see continuing evidence to build confidence that inflation is moving down sustainably toward our goal. Longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. The Fed's monetary policy actions are guided by our mandate to promote maximum employment and stable prices for the American people. My colleagues and I are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher costs of essentials like food, housing, and transportation. We're highly attentive to the risks that high inflation poses to both sides of our mandate, and we're strongly committed to returning inflation to our 2% objective. Over the past 2 years, we have raised our policy rate by 5.25 percentage points, and we've decreased our securities holdings by more than $1.3 trillion. Our restrictive stance of monetary policy is putting downward pressure on economic activity and inflation. The committee decided at today's meeting to maintain the target range for the federal funds rate at 5.25% to 5.5%, and to continue the process of significantly reducing our securities holdings. We believe that our policy rate is likely at its peak for this tightening cycle, and that, if the economy evolves broadly as expected, it will likely be appropriate to begin dialing back policy restraint at some point this year. But the economy has surprised forecasters in many ways since the pandemic, and ongoing progress toward our 2% inflation objective is not assured. The economic outlook is uncertain, and we remain highly attentive to inflation risks. We are prepared to maintain the current target range for the federal funds rate for longer, if appropriate. As labor market tightness has eased and progress on inflation has continued, the risks to achieving our employment and inflation goals are moving into better balance. We know that reducing policy restraint too soon or too much could result in a reversal of the progress we've seen on inflation and ultimately require even tighter policy to get inflation back to 2%. At the same time, reducing policy restraint too late or too little could unduly weaken economic activity and employment. In considering any adjustments to the target range for the federal funds rate, the committee will carefully assess the incoming data, the evolving outlook, and the balance of risks. The committee does not expect that it will be appropriate to reduce the target range until it has gained greater confidence that inflation is moving sustainably toward 2%. We will continue to make our decisions meeting by meeting. We remain committed to bringing inflation back down to our 2% goal and to keeping longer-term inflation expectations well anchored. Restoring price stability is essential to set the stage for achieving maximum employment and stable prices over the longer run. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to our questions.
Gina Smilek from the New York Times. Thanks for taking our questions. Obviously, in the statement and just in your remarks there, you note that you don't want to cut interest rates without greater confidence that inflation is coming down fully. I wonder, what do you need to see at this point to gain that confidence? And as you make those decisions, how are you weighing recent strong growth in consumer spending data against the sort of solid inflation progress you've been seeing?
Sorry, say that last part again.
How are you weighing the growth data and consumption data, which have been surprisingly strong, against inflation data?
Okay. So what are we looking for to get greater confidence? Let me say that we have confidence. We're looking for greater confidence that inflation is moving sustainably down to 2%. Implicitly, we do have confidence and it has been increasing, but we want to get greater confidence. What do we want to see? We want to see more good data. It's not that we're looking for better data. We're looking at continuation of the good data that we've been seeing. And a good example is inflation. So we have 6 months of good inflation data. The question really is, that 6 months of good inflation data, is it sending us a true signal that we are in fact on a path, sustainable path down to 2% inflation? That's the question. And the answer will come from some more data that's also good data. It's not that the 6 month data isn't low enough. It is. It's just a question of, can we take that with confidence that we're moving sustainably down to 2%? That's really what we're thinking about. In terms of growth, we've had strong growth. I mean, if you take a step back, we've had strong growth, very strong growth last year, going right into the fourth quarter. And yet we've had a very strong labor market, and we've had inflation coming down. So I think, whereas a year ago we were thinking that we needed to see some softening in economic activity, that hasn't been the case. So I think we look at stronger growth. We don't look at it as a problem. I think at this point we want to see strong growth. We want to see a strong labor market. We're not looking for a weaker labor market. We're looking for inflation to continue to come down as it has been coming down for the last 6 months.
And I'm sorry, if I could just follow up very quickly. When you say that you want to make sure that it's a true signal, is there anything that you're seeing in the data that makes you doubt that it's a true signal at this stage?
No, I think I would say it seems to be the likely case that we will achieve that confidence, but we have to achieve it, and we haven't yet. And so, I mean, it's a good story. We have 6 months of good inflation, but you can, and you know this, you can look behind those numbers and you can see that a lot of it's been coming from goods inflation, for example, and goods inflation running significantly negative. It's a reasonable assumption that over time, goods inflation will flatten out, probably approximate zero. That would mean the services sectors would have to contribute more. So, in other words, what we care about is the aggregate number, not so much the composition, but we just need to see more. That's where we are as a committee. We need to see more evidence that sort of confirms what we think we're seeing and that tells us that we are gives us confidence that we're on a path to a sustainable path down to 2% inflation.
Nick Timmeros of the Wall Street Journal. Chair Powell, it seems to me you raised rates rapidly over the last 2 years for two reasons. One was the risk of a wage price spiral. Two, there were risks of inflation expectations becoming unanchored. This morning's ECI report for the fourth quarter shows private sector payroll growth running at a sub 4% pace. Inflation expectations are very close to where they were before the inflation emergency of the last 3 years. And given that you appear to have substantially cut off these two tail risks, and that you've judged here today current policy is well into restrictive territory, what good reason is there to keep policy rates above 5%? Are you really going to learn more waiting 6 weeks versus 3 months from now that you have avoided those two risks?
So, as you know, almost every participant on the committee does believe that it will be appropriate to reduce rates. And for partly for the reasons that you say, you know, we feel like inflation is coming down, growth has been strong, the labor market is strong. What we're trying to do is identify a place where we're really confident about inflation getting back down to 2%, so that we can then begin the process of dialing back the restrictive level. So overall, I think people do believe, and as you know, the median participant wrote down 3 rate cuts this year. But I think to get to that place where we feel comfortable starting the process, we need some confirmation that inflation is in fact coming down. sustainably to 2%.
If I could ask differently, if you hold rates high as inflation moderates, as it has been, target rates will exceed the prescriptions of the Taylor rule or its variants. What would be the reasoning for holding rates higher than the levels recommended by those rules in the current instance?
Well, look, I think, as you know, we consult a range of Taylor rules and non-Taylor kind of rules. We consult them regularly. They're in our Teal book, and they're in all the materials that we look at. But, you know, I don't think we've ever been at a place where we were setting policy by them. And they're, depending on the rule, it will tell you different things. There are many different formulations. Another way to think about it is, implicitly, is so in theory, of course, real rates go up if holding all else equal as inflation comes down. But that doesn't mean we can mechanically adjust policy as real rates, as inflation comes down. It doesn't mean that at all, because for one thing, we don't know. We look at more than just the Fed funds rate. We look at broadly financial conditions. But in addition, we don't know with great confidence where the neutral rate of interest is at any given time. But that also doesn't mean that we wait around to see the economy turn down, because that would be too late. So we're really in a risk management mode of managing the risk, as I mentioned in my opening remarks, managing the risk that we move too soon and move too late. And I think to move, which is where almost everyone on the committee is in favor of moving rates down this year. But the timing of that is going to be linked to our gaining confidence that inflation is on a sustainable path down to 2%.
Hi, thanks, Chair Powell. I'd like you to key in on the use of the word in the statement that inflation still remains elevated. You've pledged to cut rates before inflation reached 2%. So that implies that there's some sort of intermediate step here on inflation, and that a cut would be consequent with a change in the statement language that inflation remains elevated. What's the step down from there?
Yeah, I don't know that we've worked out the particular statement language and that kind of thing. I would just say, if you look at where 12-month inflation is, and it's still well above. Core is 2.9%, for example, 12 months, which is way down from where it was. Very, very positive development, very fast decline, and the case is likely that it will continue to come down. So that's where it is. But we're wanting to see more data.
So if I could follow up on that, the statement allows that you want greater confidence on inflation falling before you cut, but it doesn't mention the other side of the mandate, a slide in employment. Would a slide in employment also bring you to the point of cutting rates?
Yes. So let me say that we're not looking for that. It's not something we're looking for. But yes, if you think about, in the base case, the economy is performing well. The labor market remains strong. If we saw an unexpected weakening certainly in the labor market, that would certainly weigh on cutting sooner. Absolutely. And if we saw inflation being stickier or higher or those sorts of things would argue for moving later. In the base case, though, where the economy is healthy and we have ongoing growth, solid growth, we have a strong labor market, we have inflation coming down, that's what people are writing their SEP around. And in that case, what we're saying is, based on that, we think we can and should take advantage of that and be careful as we approach that question of when to begin to dial back restriction.
Claire Jones, Financial Times. Just to circle back to the greater confidence aspect of the statement, there's been a lot of unanimity in recent meetings. I'm just wondering, going forward, when it comes to all needing greater confidence, is the unanimity, or at least consensus among FOMC members, about what the threshold for that greater confidence is? And if not, could you maybe tell us a little bit about the discussion today on, what the variations between FOMC members was on what constitutes enough confidence to cut rates, and also if there was any variation on how quickly that greater confidence threshold could be reached. Thank you.
We're not really at that stage. There was no proposal to cut rates. Some people did talk about their view of the rate path. I would point you to the SEP. as good evidence of where people are, although it is one cycle later. So, we're not at a place of really working out those kinds of details because we weren't actively considering moving the federal funds rate down. I will say there is a wide disparity, a healthy disparity of views, and you see that in public statements, in the minutes and the transcripts when they're released every 5 years. So we do have a healthy set of differences, and I think that's actually essential for making good policy. We're also able to reach agreement generally because we listen to each other, we compromise, and even though not everybody loves what we do, they're able to, for the most part, able to join in. And to me, that's a well-functioning public institution.
Hi, Chair Powell, Rachel Siegel from the Washington Post. Thanks for taking our questions. So over the past few years, there have been all these real-time indicators that helped us gain a sharper understanding of where the economy was, like open table data or office attendance. You've talked about vacancies in the past. And I'm wondering at the start of this year, what might be on that dashboard for you that's giving you the clearest picture of the economy, including on rents, if you could touch on that.
Including?
Rent costs.
Yeah. Well, so we're not, it's not the pandemic, so we can actually rely on more traditional forms. People are working, they're getting wages, and the economy is largely reopened and is broadly normalizing, as you see. So I wouldn't say we're looking at that sort of more innovative data as much. You point to rent. So, of course, we follow the components of inflation very carefully, which would be goods inflation. I talked about that a little bit. You mentioned housing inflation. So the question is, when will these lower market rents find their way into measured rents as measured in PCE inflation? And we think that's coming. And we know it's coming. It's just a question of when and how big it'll be. So, but that's in everyone's forecast, I would say. So that will help. But at the same time, we think goods inflation will probably, it's been giving a lot of disinflation to the effort, and probably that declines over time. But it may well have some more time to run. The supply chains are not perfectly back to where they were. In addition, it takes time for the healing process to get into prices. So there may be still a tailwind. We'll find out with that. So we look at the things that relate to our mandate very carefully, and as you would imagine.
I guess just as a quick follow-up, do you feel comfortable at this point saying the economy has reached a soft landing, or is that part of looking for more confidence?
No, I wouldn't say we've achieved that, and I think we have a ways to go. Inflation is still, core inflation is still well above target on a 12-month basis. 12 months is our target. Certainly, I'm encouraged, and we're encouraged by the progress, but we're not declaring victory at all at this point. We think we have a ways to go.
Thank you, Mr. Chairman. You've said that you would know the neutral rate by its works. So I'm wondering what you could tell me. How do you believe the neutral rate is working? We're telling you right now that growth is stronger. In other words, how much is the economy really being restrained right now by the current funds rate? And how much restraint does it really need additionally if inflation is still coming down?
So I think you do see in the interest-sensitive parts of the economy, you do see, for example, housing, you see the effects, you do. Your second question, though, really, I think is important, and that is a lot of this has come through, a lot of the disinflationary process has come through the healing of supply chains and also of the labor market. So you've seen that other set of factors is really different from other cycles and has brought that working with tighter policy, which has enabled the supply side to recover, I think that mixture has been behind what has enabled this. So no, we really do think that we're having an effect broadly across the economy. I would point to the interest-sensitive parts of the economy as well as spending generally. But it's a joint story. It's a complicated story.
But how much restraint are you actually imparting to the economy, would you say, relative to the neutral rate?
So I think it's of course, that it's not something you can identify with any precision. But a standard approach would be to take the nominal rate, 5.3%, let's say, and subtract sort of a forward measure of inflation. If you do that, and there are many, many ways to calculate that neutral rate, but that's one I like to do. And you're going to get to something that is materially above mainstream estimates of neutrality, of the neutral rate. You will. But At the same time, you look at the economy and you say, this is an economy that grew 3.1% last year. And you say, what does that tell you about the neutral rate? What's happening, though, is the supply side has been recovering in the middle of this. So that won't go on forever. So a lot of the growth we're seeing it isn't just a tug of war between interest rates and demand. You're getting, more activity because of labor market healing and supply chains healing. So I think the question is, when that peters out, I think the restriction will show up probably more sharply.
Thank you. Sorry. Thanks for taking the question, Mr. Chairman. You mentioned earlier we're not seeking a weaker labor market. I think you said. Can you talk a little bit more about that? Do you think the labor market now is back to quote unquote normal, and that we can achieve the inflation target without wage gains coming back down to what they were pre-pandemic? Even with today's ECI levels, they were still above those pre-pandemic levels.
I think the labor market, by many measures, is at or nearing normal, but not totally back to normal. And you pointed to one or more of them. So I think job openings are not quite back to where they were. Wage increases rather are not quite back to where they would need to be in the longer run. I would look at it this way, though. The economy is broadly normalizing, and so is the labor market. And that process will probably take some time. So wage setting is something that happens. It's probably will take a couple of years to get all the way back, and that's okay. That's okay. But we do see. You saw today's ECI reading. The evidence is that that wage increases are still at a healthy level, very healthy level, but they're gradually moving back to levels that would be more associated, given assumptions about productivity, are more typically associated with 2% inflation. It's an ongoing process, a healthy one, and I think we're moving in the right direction.
So that process can continue without a weakening of the labor market, basically, you're saying?
Well, I think the labor market is, I don't know if it's rebalancing. Clearly, there was a fairly severe imbalance between demand for workers and supply at the beginning of the pandemic. So we lost several million workers at the beginning of the pandemic from people dropping out of the labor force. And then when the economy reopened, you remember 2021, you had a severe labor shortage, and it was everywhere. Panic on the part of businesses, couldn't find people. So what's happened is we expected the labor market to come back quickly, and it didn't. And 2022 was a disappointing year. And, we were kind of thinking, well, maybe we won't get it back. And then 2023, we did, as you know. So labor force participation came back strongly in 23, and so did immigration. Immigration came to a halt during the pandemic. So those two forces have significantly lowered the temperature in the labor market to where it's still a very strong labor market. It's still a good labor market for wages and for finding a job, but it's getting back into balance. And that's what we want to see. And one great way to look at that is what's happening with wage increases. And you see it now across the major things that we track. It isn't every quarter, but overall there's a clear trend, still at high levels, but back down to what would be consistent with where we were before the pandemic and with 2% inflation.
Hi, Chris Rugaber at Associated Press. Thank you. I wanted to follow up on Rich's question. It sounded like you suggested that you're not worried about faster growth so much. So wanted to see if you're seeing anything that suggests that inflation could reaccelerate from here. And it sounds like you're saying you're not worried that solid growth from here on out poses any risk to inflation. Thank you.
No, I think that is a risk, the risk that inflation would reaccelerate. I think the greater risk is that it would stabilize at a level meaningfully above 2%. That's to me more likely. Of course, if inflation were to surprise by moving back up, we would have to respond to that, and that would be a surprise at this point. But I have to tell you, that's why we keep our options open here and why we're not rushing. So I think both of those are risks, but I think the more likely risk is the one that I mentioned, which is you've had 6 good months, very good months. But what's really going to shake out here? What will, when we look back, what will we see? Will inflation have dipped and then come back up? Are the last 6 months flattered by factors that are one-off factors that won't repeat themselves? We don't think so. We don't. That's not what we think. But that's the question we are asking. We have to ask, and we want to get comfort on that.
And just one quick follow-up. Governor Waller had mentioned the revisions that are coming on February 9th for the CPI data. Is that something you're watching as well? And if we see those revisions fairly minor, is that going to give you more confidence where things are going?
We'll just have to see. Yeah, we'll look at those. Last year was a surprise.
Michael McKee, Bloomberg Radio and Television. If you don't want to use the term soft landing, would you say at least that from your point of view now, the other scenario of a hard landing caused by the Fed is off the table, or the risks have diminished very much? And you mentioned below 2% inflation on a 3-month basis. Core PCE has been running at 1.5%. And there are those on Wall Street who think that if you maintain the level of restriction you have right now, you could end up with inflation running below your target. How do you see that?
So your first question, how to describe where we are. So I guess I would just say this. Executive summary would be that growth is solid to strong over the course of last year. The labor market, 3.7% unemployment, indicates that the labor market is strong. We've had just about 2 years now of unemployment under 4%. That hasn't happened in 50 years, so it's a good labor market. And we've seen inflation come down. We've talked about that. So we've got 6 months of good inflation data and an expectation that there's more to come. So this is a good situation. Let's be honest. This is a good economy. But what's the outlook? That's looking in the review. The outlook, we do expect growth to moderate. Of course, we have expected it for some time, and it hasn't happened. But we do expect that it will moderate as supply chain and labor market normalization runs its course. The labor market is rebalancing, as I mentioned. Job creation has slowed. The base of job growth has narrowed. And of course, 12-month inflation is above target and getting down closer to target. It's not guaranteed, but we do seem to be getting on track for that. So those are the risks and questions we have to answer. But overall, this is a pretty good picture. It is a good picture. Your second question was, sorry.
Could you get inflation that is below target, end up with inflation below target, and you have to do something about that?
So the thing is, we're not looking for inflation to tap the 2% base once. We're looking for it to settle out over time at 2%. And the same thing is true. If we have a month or two of lower, and we have that now, of inflation that's annualized at a lower level, that wouldn't be good. We're not looking to have inflation anchor below 2%. We're looking to have it anchor at 2%. So if we do face those circumstances, then we'll have to deal with that. I think as of now, the question, we want to take advantage of this situation and finish the job on inflation while keeping the labor market strong.
Edward Lawrence from Fox Business. Thank you, Mr. Chairman, for taking this. So as I've heard from some district Fed presidents, is it, in your view, a little premature to think that rate cuts are right around the corner? And then when we do see that first rate cut, should we interpret that as the beginning of a rate cut cycle, or is it a one-off?
So I'll point to that language on your first question. We included that language in the statement to signal clearly that with strong growth, strong labor market, inflation coming down, the committee intends to move carefully as we consider when to begin to dial back the restrictive stance that we have in place. So if you take that to the current context, we're going to be data dependent. We're going to be looking at this meeting by meeting. Based on the meeting today, I would tell you that I don't think it's likely that the committee will reach a level of confidence by the time of the March meeting to identify March as the time to do that. But that's to be seen. So I wouldn't call, when you ask me about in the near term, I'm hearing that as March. I would say I don't think it's probably not the most likely case or what we would call the base case. Then your second question is
is this the start of when we see a cut, is it the start of a cutting cycle, or could it just be a one-off?
That's going to depend on the data. The whole thing is this is going to depend on the data. We're going to be looking at the economic data as it affects the outlook and the balance of risks, and we're going to make our decisions based on that. And it could wind up, we'll have another SEP at the March meeting, and people will write down what they think. But in the end, it's really going to depend on how the economy evolves. We talked about there are risks that would cause us to go slower. For example, stronger inflation, more persistent inflation. There are risks that would cause us to, or if they happened, that would cause us to go faster and sooner, and that would be a weakening in the labor market, or for that matter, very, very persuasive lower inflation. Those are the kinds of things. So we're just going to be reacting to the data. That's really the only way we can do this.
Victoria. Hi, Victoria Guido with Politico. Could you talk a little bit more about productivity growth? You've mentioned multiple times about, the level of wage growth that's consistent with 2% inflation. We've obviously seen, you were talking about ECI this morning, in which it's cooled a little bit, but still sort of above what you wanted to see. Growth has been very strong. How much of those numbers do you attribute to productivity, and do you see that productivity as sort of just temporary because of the factors, the labor and supply chain factors you were talking about, or do you think that productivity growth will fade over time?
So this is a really interesting question, and I think my own view is, I think if you look back to the pandemic, you saw a spike in productivity as workers were laid off and activity didn't decline as fast. And then you saw a deep trough of productivity. And then over the last, you saw high productivity last year in 23. I think we're basically in the throes of getting through the pandemic economy. And the question will be, what is it that has changed? The productivity tends to be based on, fundamental aspects of our economy. Is there a case, will it be the case that we come out of this more productive, more on a sustained basis? And I don't know. What would it take? It would take, people talk about AI, but my guess is that we may shake out and be back where we were, because I'm not sure I see work from home doesn't seem like it's a big productivity increaser. AI, artificial intelligence, generative may be, but probably not in the short run, probably maybe in the longer run. So I'm not seeing why it would, but right now I would say the productivity is kind of what falls out of the broader forces that are driving people in and out of the labor force and activity returning and supply chains getting fixed.
Right. So would that be behind why we've seen such strong growth, but we've also seen inflation fall? That maybe there's just a higher level of productivity.
That's
right
one
now?
way to look at it. Yeah.
Hi, Chair Powell. Nancy Marshall-Genzer with Marketplace. I want to ask a little bit more about housing. I'm wondering, how closely are you watching rent and housing prices as you evaluate whether and when to cut rates? And it seems like housing prices are not coming down as quickly as you expected.
So when we think about, our statutory goals are maximum employment and price stability, and that's what we're targeting. We're not targeting housing price inflation, the cost of housing, or any of those things. Those are very important things for people's lives, but they're not, those are not the things we're targeting. We're also well aware that when we cut rates at the beginning of the pandemic, for example, the housing industry was helped more than any other industry. And when we raise rates, the housing industry can be hurt because it's a very interest-sensitive sector. On top of that, we have longer run problems with the availability of housing. We have a built-up set of cities, and people are moving further and further out. So there hasn't been enough housing built, and these are not things that we have any tools to address. But where it comes into play very specifically in our work is inflation, which is a combination. It's really rental inflation. You're taking owner's equivalent rent and then actual rent paid by tenants, and you're running that through the CPI calculation or the PCE calculation, the one we look at. And what that's telling you is that market rents are increasing at a much lower rate or even being flat, and that will show up in inflation over time. It has to, as long as that remains the case. So.
And just real quick, what is your response to the letter that was sent to you by some members of Congress asking the Fed to lower interest rates to make housing more affordable?
My response is what I started with, which is that our job, the job Congress has given us, is price stability and maximum employment. Price stability is absolutely essential for people's lives, most importantly, not most importantly, mostly for people at the lower end of the income spectrum who are living at the edges, at the margins. And so for someone like that, high inflation, in the necessities of life, right away you're in trouble. Whereas even middle class people have some scope to absorb higher costs. So we have to it's our job, it's what society has asked us to do, is to get inflation down. And the tools that we use to do it are interest rates. So that's how we think about that.
Courtney Brown from Axios. Can you give us some insight into whether the committee discussed the possibility of slowing balance sheet runoff in the months ahead?
Yes. So I would start by saying that balance sheet runoff so far has gone very well. And as the process has continued, we're getting to that time where questions are beginning to come into greater focus about the pace of runoff and all that. So at this meeting, we did have some discussion of the balance sheet, and we're planning to begin in-depth discussions of balance sheet issues at our next meeting in March. So those questions are all coming into scope now, and we're focusing on them. But we're at the beginning of that process, I would say.
Quick follow-up. Is it the case that the Fed would decide to lower rates and make adjustments to the balance sheet runoff in tandem?
Yes, we do. We see those as independent tools, and so they don't. For example, if you're normalizing policy, you might be reducing rates but continuing to run off the balance sheet. In both cases, that's normalization. But from a strict monetary policy standpoint, you could say we're loosening and one with tightening. So that could happen. It's not something we're planning or thinking about, but right now we're thinking about getting to a place where we're going to see the balance sheet runoff to continue. We're watching it carefully, and as I said, we'll be looking into that as a committee starting in March.
Thanks.
Simon Urbanovich with The Economist. Thank you, Chair Powell. You've mentioned 6 good months of inflation data, but that not being enough to build up confidence. Based on your previous response that your base case is you probably wouldn't start easing yet in March, the implication is that 8 good months might not be enough either. Roughly how many months do you think you might need of good inflation data to be confident?
Yeah, I'm not in a position to put a number on it. I'm just going to say, it's not that we don't have any confidence. We have growing confidence, but not to the point where we feel like it's a highly consequential decision to start the process of dialing back on restriction. And we want to get that right. And we feel like the strong economy, strong labor market, inflation coming down, it gives us the ability to do that. We think that's the best way we can serve the public because ultimately we've made a lot of progress on inflation. We just want to make sure that we do get the job done in a sustainable way. That's how we're thinking about it. In terms of when that'll be, that'll all come out of our communications. We won't keep that a secret.
Hi, Chair Powell. Evan Reiser with M&I Market News. Can you explain a little bit more on what you're considering when tapering QT? Do you need to see the overnight reverse repo facility all the way down to zero, or is it something that you can start with a couple $100 billion there?
Not a decision that we've made, but I wouldn't think we wouldn't be taking a position that it's got to go to zero. I mean, if it were to stabilize at a different level, but that's not a decision that we've made. That's what we'll be talking about at the March meeting. A whole range of issues will be briefed up, and the committee will get into all of the issues that will be arising over the course of the next, let's say, year or so.
Thanks, Greg Robb from MarketWatch. Chair Powell, I want to change gears a little bit. In the presidential primary campaign that's been going on for the last 9 months or so, your name has come up often, and many Republican candidates had said that they probably wouldn't want to give you a third term. So I wanted to give you chance to talk about that. Do you want another term? You've had on the Fed. What's your stance on that?
I don't have a stance on that. It's not something I'm focused on. Focused on doing our jobs. This year is going to be a highly consequential year for the Fed and for monetary policy, and we're all of us very buckled down, focused on doing our jobs.
Thank you, Chair Powell. Jennifer Schonberger with Yahoo Finance. As you mentioned, core PCE has been running at 1.9% over the past 6 months. And you guys are actually expecting core inflation higher this year at 2.4% compared to that 6-month measure. Given that forecast and that the median is for 3 rate cuts this year, what happens if inflation stays where it's been over the last 6 months for the next 6 months?
So we'll update our inflation forecasts at the next meeting. You referred to the December meeting. That's 3 months old, so it might be lower now given the data we've gotten. So look, as I mentioned, we're going to be reacting to the data. If we get very strong inflation data and it kicks back up, then we'll go slower or later or both. If we got really good inflation data soon, that would matter for both that would tell us that we could go sooner and perhaps go faster. So we're just going to be, but of course we'll weigh that with all the other factors. We're setting policy based on the totality of the data.
But just to follow, if inflation stays where it is currently, that would probably mean that the real interest rate becomes more restrictive. Would that mean you'd have to trim more, perhaps, than you already have factored in?
Well, I think if we came to the view that that the 6-month inflation numbers, which are very close to 2, were in PCE world, if we thought that is really where we're going to be, then yes, our policy would be in a different place. It would. But that's the whole point, is we're trying to get comfortable and gain confidence that inflation is on a sustainable path down to 2% or toward 2%.
Hi, Chair Powell. Daniel Davis, Agence France-Presse. I just wondered if I could get your comment on the recent consumer confidence data. It seems to suggest that consumers are sort of moving towards a much more optimistic view of the economy. I just wonder, is it fair to say that they're moving towards where the Fed appears to have been in recent months? And do you think that inflation and falling inflation perhaps has played a role in that? And what challenges do you see going forward? Thank you.
Yeah, so it's been interesting that confidence surveys have been weak at a time when unemployment has been low, very low, historically low for a couple of years. But nonetheless, that's been the case. And we've asked ourselves why that is. And one obvious answer, we don't pretend to have perfect wisdom on this, but one obvious answer is that the price level is high. So prices went up much more than 2% per year for a couple of years, and people are going to the store and they're paying much more for the basics of life than they were 2 years ago, 3 years ago, and they're not happy about it. And it's fine that inflation's coming down, but the prices they're paying are still high. So that is what that has to be some part of why people are unhappy, and they're right to be unhappy. This is why we need to keep price stability. It's why we need to do our jobs, is so that people don't have to deal with things like this. In terms of you're right. In recent surveys, you've seen a couple of significant increases in consumer confidence or happiness with the economy. I guess that's a good thing. That can support spending, can support economic activity. There's some evidence of that. But it is a fact that we have seen a meaningful increase. I think levels of confidence are still maybe not as high as they've been at various times, but they certainly have come up.
Thank you for taking our questions. Brian Menes, CNN Business. Committee members have said they'd like to meet with business leaders and stakeholders in person to learn more about the economy in real time, given that some data is subject to large revisions, the issue of seasonal adjustments being thrown off balance, and many readings of the economy being quarterly. So did any members say they've learned anything not yet reflected in the data, or have you yourself learned anything through anecdotal evidence that hasn't been captured in the data yet?
Well, yes. I'm a big believer that yes. So we do meet with outside groups who come from all different parts of the economy, and I always feel like I mean, I spent most of my life in the private sector looking at companies, individual management teams, and then building out from that. And so starting with GDP data and working into what's actually affecting people's lives is challenging. It's very hard. So I really like anecdotal data. In addition, as you know, the 12 reserve banks have really the best network of anyone. That in all their districts, they're talking to, not just the business community, but the educational, medical, all nonprofit community. They have arms into all of that. And so when they come back, that's what goes into the beige book. But that they come back, and what each Reserve Bank president does is during the Outlook go-around, they'll say, in my district, and they'll talk about 100 conversations. They won't talk up. They will give you input based on 100 conversations that they've had with people of all different walks. And I personally find it very helpful in understanding what's going on. And also, I think you hear things before they show up in the data sometimes.
Did any of them notice slowing economy based on what they've heard from their district?
Yes, I mean, if you look back at the last, not this beige book, but the one before, there was a lot of slower activity. I think that what you're hearing now is things are picking up a bit. You're hearing not in every district, and not every person that we talk to, but you're overall, it feels like you're hearing things picking up at the margin. So that's what comes through.
Thank you, sir. Jeff Cox from CNBC.com. Just kind of looking to put it all together. You had talked about basically the economy looking strong with 3.3% annualized growth in the fourth quarter. Does the strength of the economy speak more loudly to you now than any inflation threat might? That you're in a position, in other words, to keep rates elevated as long as the economy stays strong, and you're more tilted towards that. And then also, perhaps, are you worried at all that the economy is maybe a little too strong right now, and that inflation could come back at some point?
I'm not so worried about that. It's again, we've had inflation come down without a slow economy and without important increases in unemployment, and there's no reason why we should want to get in the way of that process if it's going to continue. So I think declining inflation, continued declines in inflation, are really the main thing we're looking at. Of course, we want the labor market to remain strong too. We don't have a growth mandate. We've got a maximum employment mandate and a price stability mandate, and those are the two things we look at. Growth only matters to the extent it influences our achievement of those two mandates. Thank you very much.
That wraps up the meeting for Chairman Powell, live from New York City. Good afternoon to you all. This is a Bloomberg Surveillance special, The Fed Decides. I think we all need to lie down after the last 1 hour or so. There is 3 steps to this. Step 1, accept you're finished. Chairman Powell saying the policy rate is likely at its peak. Step 2, acknowledge the next step. It's appropriate to dial back at some point this year. And step 3, attempt to explain the threshold to do so. Take a listen.
What do we want to see? We want to see more good data. It's not that we're looking for better data. We're looking at continuation of the good data that we've been seeing. And a good example is inflation. So we have 6 months of good inflation data. The question really is, that 6 months of good inflation data, is it sending us a true signal that we are in fact on a path, a sustainable path down to 2% inflation?
That's not good enough for this market. It wants to know about March rate cuts. This is what the chairman had to say.
Based on the meeting today, I would tell you that I don't think it's likely that the committee will reach a level of confidence by the time of the March meeting to identify March as the time to do that. But that's to be seen.
And this is what you get in this market off the back of it all. An equity market that sells off on the S&P 500. Session lows down 1.2%. On the Nasdaq, down 1.5%. In the bond market, we had a big rally. Still got a decent rally, but yields are off the lows of the session. We're down 7 or 8 basis points on a 2-year. 426 on a 10-year, down 5. Lisa, 397.85. We're talking about cuts, kinda. We're just not talking about March.
We were supposed to hear him hug the statement, and he did. He gave this ambiguous answer that didn't necessarily say anything at all. We didn't learn anything, and that was exactly what he was hoping for. And then he said the M word, March, and he actually answered the question, and the market responded to that. You know, whether it sticks, we shall see. But that clearly was a signal that was not necessarily in the statement.
TK, they just did not sound comfortable, or at least Chairman Powell does not sound comfortable, suggesting we're cutting anytime soon.
Yeah, but sorry, I mean, the clarity there was the March idea. Claudia saw him out on Twitter saying that was the bombshell. Is clearly they've moved March out of the way. What an odd press conference. I got one word, John: timid. The timidity here, the carefulness is extraordinary. I felt like I was looking at a Bank of Japan meeting from 25 years ago. The point there, they had a data thing that sounded like one of our famous SOT strings, data, and it's just framing out the fear they have and the delay that they're going to cause.
There was something that didn't come up in this news conference. I was surprised there weren't more questions about what happened in a banking system today, what happened with one particular bank, New York Community Bank, because, Lisa, that's what we were talking about in anticipation of the decision for much of today.
It was such an easy question, but I guess it didn't sound very sophisticated. How much do you count that? Does that worry you? Does that factor in? When does that become an issue that actually ends up causing you to cut rates more quickly?
The thing to me here, John, is the behavioral aspect of this meeting. These are smart people. They put on their pants one leg at a time, et cetera. And the answer is the timidity I heard today was just, I've never heard that timidity.
Question, ever. QT. Let's get the folder out, get to the right page.
That was amazing.
So far, it's gone very well. We had some discussion of the balance sheet. We're planning to have an in-depth discussion in March. We're at the beginning of that process. We see rates and a balance sheet as independent tools. They're not there yet, and I think that's the frustration with markets today. Chairman Powell is deeply pragmatic. He's trying to go through this step by step, have a clear sequence of things. The market wants it right now. Wants to talk about March rate cuts, wants to move Bramo, and that's not what you heard in today's news conference.
Wants to know even what the criteria are. The criteria is when we decide what the criteria will be, and depending on which member. I mean, the idea of the data just needs to continue to be good. And then how long does it need to be good? 6, 7, 8 months? I don't know. We shall see. And that seemed to be sort of this feeling, maybe because each member has a slightly different view as they try to gauge a really uncertain economy.
Thank you for joining us on television and radio. And what we're going to do is talk to people with historical perspective about this moment as we all stagger into 2024. William Dudley, out of Berkeley, on tenure at Goldman Sachs for years, and of course a former New York Federal Reserve president, Bloomberg economics senior advisor. You know, Bill, I feel like I want to go and talk to Eichengreen or Brad DeLong right now out in the hallways at Berkeley. The timidity I see here, the carefulness. Let's start with the why of the moment. Why are they so darn data dependent and careful here to begin a measured trend of lower rates?
I think they're so careful because things are actually going very well. If the economy wasn't as strong as it was, the Fed would be much more inclined to cut rates. But since we've seen very strong growth in the fourth quarter, the Fed's aware of the fact that if they start a little bit later, it's probably not going to have very much consequence for the economic outlook. The fact that financial conditions have eased over the last few months also allows the Fed to be a little bit more cautious. So I think it's really the strength of the economy, the easing of financial conditions, means the Federal Reserve is of the view that they can be a little bit more patient. I thought that was a very interesting press conference because up until the point that Chair Powell talked about the March meeting specifically, the market was actually taking it as March was in play. And then he explicitly took it off the table. And the federal fund futures contracts went from pricing in more than 50% probability of a rate cut in March to significantly less. So I think that was the big surprise at the meeting for me. I thought the other interesting aspect of the meeting was the discussion about the quantitative tightening. So that's clearly being put on the table. They talked about it today. We're going to have an in-depth staff presentation in March. So I think we could expect quantitative tightening tapering to happen sometime, probably around the first half of this year.
Bill, let's unpack some of that. I'll get to QT in a moment. I just want to talk about the strategic ambiguity. So in the statement, this is what they said. The committee does not expect it will be appropriate to reduce the target range until it has gained greater confidence that inflation is moving sustainably towards 2%. So obviously, our former colleague, good friend, Judith Smilik of the New York Times, first question out the gate, wants to know what greater confidence actually means. We want to see more data. We're not looking for better data, just more good data. So, Bill, dare I ask, what does it mean?
I think what he wants to see is more of the same. I think that's basically what he said. I think they're, a little bit of concern that maybe the really good inflation news that we're seeing is a little bit about goods price weakness, and that may ultimately fade away, so that there might be a little bit more work to do on the services side. So I think that's their concern. I mean, if the inflation news continues along the same course for a few more months, then the Federal Reserve is certainly going to start to cut rates. They're just not absolutely confident that that's where we're going to be 3 or 4 months from now.
Bill, do you think that it was a mistake for Fed Chair Powell to say that March was not on the table?
I don't think it's completely off the table. All he said was, I don't think at the current point that we'll be confident enough in March. But, weak economic data, better inflation news, then he may be confident by the time we get to March. And March meeting is still a ways off. So, his degree of confidence could change between now and then.
Bill Dudley, I look at some of the criticisms here that they're on trend of disinflation. Jason Furman up at Harvard has a wonderful blending of annualized vectors and such. Which vector do you use? If they're on the vector, when do they start? What's the Dudley vector where you measure our disinflation?
Well, I think I think we're still in a very tricky period because we had lots of goods inflation during the pandemic. Then we opened up the economy. That goods inflation went away. In fact, we're actually getting goods deflation now. And the real question is, how long will that goods deflation last? Because if it ends, then inflation pressures could actually start to be more evident again. Offsetting that is the fact that services inflation should also come down as wage gains become more modest. And I think the Employment Cost Index report today was a positive reading that wage trends are becoming more consistent with 2% underlying inflation.
Bill, you mentioned QT. Can we just finish there with you? Did you get the sense from the chairman that he wants to end QT before he starts to reduce interest rates, or that we can see those two things play out independently?
I think they're completely independent. Ending QT is not about loosening monetary policy. It's about basically getting the level of reserves in the banking system down to a level that's as low as possible without the reserve level actually affecting interest rates. So this is totally independent of the decision about whether you want to make monetary policy more accommodative. This is based on the bank's demand for reserves, and the Fed's trying to estimate what that demand is, and they want to make sure that there's enough reserves in the banking system, but not too much. So they want to have a cushion over the bank's underlying demand for reserves, and they're going to try to they're going to do the taper to make sure that they approach that place very, very carefully. They recall what happened in September 2019, where we crashed through the level of reserves that banks demanded, and we got an upward spike in repo rates and quite a bit of turmoil in the money market, and the Fed wants to avoid that this time.
Bill, are you surprised that nobody asked about New York Community Bank, and how would you have responded to a question about how that factors into the Fed decision-making process in the next few months?
I think the Fed is not that worried about some of the regional banking issues because I think that they're really bank by bank now. And I think this is all happening in plain sight. This is not like the great financial crisis where you really couldn't evaluate the situation for individual banks. Right now, you can sort of see what's happening to banks' net interest margin. You can see what's happening to the losses on their securities portfolio. You can see what kind of earnings pressure they're under. So I don't think the Fed views the banking system issue as very important right now. Now, could that change? Could something break? And I think the other thing that makes them a little bit more confident about this is long-term interest rates have come down. We peaked, 10-year Treasury yields peaked around 5%, now around 4%. And so that pressure on banks that took a lot of interest rate risks, they're still under pressure, but that pressure is less than it was a year ago.
Going forward, I am curious about Jay Powell and the March discussion. He didn't hug the statement precisely the way that Rich Clarida suggested that maybe he ought to. Do you think that this is actually a sign of how there is Jay Powell, the man, and Jay Powell, the herder of cats, that is the Fed committee? I mean, how much is that basically what we're seeing?
I don't think he really departed from the statement in any meaningful way. I think he just gave a little bit more nuance to what the Fed, how the Fed's thinking is evolving. Obviously, the statement is, pretty short and pretty concise. And the Fed's very careful about the changes that they make in the statement. And obviously in a press conference, you can't be quite that precise. So I thought he tracked the statement quite well.
Bill, what are you thinking? June cut? What's your view now?
I've been thinking May, and I don't see any reason to change that.
May. Bill Dudley, thank you, sir. Former New York Fed President. TK, we got an answer. He's thinking May.
You got an answer. You got an answer for Mr. Powell on March, too. Did you see the market move on March?
Let's get to that market move right now. Equities pulling back by 1.4% on the S&P 500. The Nasdaq is lower as well. Tech earnings were, let's say, underwhelming yesterday after the close. More tech earnings to come tomorrow. Amazon, Meta, Apple still to come Thursday after the close. The Nasdaq is down by 1.7%. I've missed you. Small caps lower by 1.7%. Let's turn to the bond market. 2-year, 10-year. 30-year. The 10-year yield down 4 basis points, 3.99, down 6 on a 2-year. So the Federal Reserve has stepped away from this tightening bias, Bramo, but ultimately, when it starts to engage the rate cut conversation, just not in the way that this market wanted to see it do it. It wanted more than just, OK, things are going well, we need to see a little bit more, but ultimately, the next move might be a cut, and it might be this year, just probably not March, not likely.
Basically, what you're seeing is the market is now pricing in a 38% chance of a March rate cut, down from almost a 60% chance of a rate cut come just before this press conference. The market adjusted. Will it last? We shall see. Tomorrow should be a whole new story. It seems like the Fed is being somewhat consistent toward that May kind of timeline, which is the reason why we've got 91% chance currently priced in.
What was interesting, and we haven't talked about it yet, is just how comfortable he would be with decent growth, strong growth. I think that's a change. You go back to the Jackson Hole Symposium of, what was it, 2022 in August? Pain. And now he's saying basically strength is OK. It's not something we have to work against.
This is basically the Fed not necessarily saying victory, but saying we could get victory, and we're not going to get in the way of it, right? I mean, how much is this a sort of acceptance of this concept that disinflation is good, regardless of whether the strength might suggest that, you know, it could be a problem?
I'll be quicker. I know you want to get to Mike McKee, who was in the press conference. To me, the huge overlay here is gut fear by monetary economics people about getting this wrong. Willie Pesic in Forbes used to write for Bloomberg. Nailed it. Willie Pesic wrote it on the Bank of Japan, and I'm sorry, they are scared stiff of getting this wrong.
They want to see more data, Tom. I'm totally with you. Yeah. You can see they're uncomfortable. Chairman Powell ultimately is still concerned that inflation stabilizes above target. For him, that still seems to be a risk.
It's a risk for all the people who we speak to as well, especially with that strength. What's the bigger fear, though? And this, I think, is different. Is it that inflation reaccelerates, or is it that they do serious damage to a labor market that seems to be in a good place? And that, to me, seems definitely more balanced.
And Mike McKee with us now. He was in the news conference. Mike McKee, fantastic work as always, sir. What was your big takeaway, Mike, from that presser?
Well, basically, the Fed has gone to where the market wanted it to be, but they didn't go farther, as you were talking about. They're not giving us a timetable yet, but leaving enough ambiguity that you could try to figure it out on your own. Basically, May comes into the equation then, because by that time, they'll have 3 more PCE inflation data releases, and they'll have a pretty good idea of whether or not we're going to be able to maintain this in the 2% range inflation level. So I think Powell was just trying to tell people, we've heard you, we see what you see, but we want to make sure that we're not going to be seeing inflation go up again. To what you were just saying, I think they still think inflation is a greater danger. Growth is not a problem at this point. Of course, that was my question to him. They're happy with the way the economy is going. They're happy with the way unemployment is going. And they don't seem to think it's going to get any worse. But there's still an issue about, will inflation continue to come down?
Mike, you were in the room, so you've got a better sense of this than us. It felt guarded at times, very scripted. Lisa talked about that. Former Fed Vice Chair Richard Clapper talked about that as well in anticipation of the news conference. But did you get the sense that March comment was unscripted? That was off the cuff? That was from the chairman directly?
No, I think that basically he went in ready to say that, probably didn't want to unless he had to, because they never like to put a time frame on anything. But you'll get just one more PCE report before that time, and that's probably not going to be enough for them. So it wasn't that he couldn't say it. I think he didn't want to, but was asked directly about it, so did.
Mike, with Lagarde in the ECB, we parse the hawks. We know who the hawks are. Who are the hawks pushing against Powell's dovishness? Who are the people out there? Bush Cassidy. Who are those guys out there that are hawks right now?
Well, we know that Mickey Bowman has been a hawk and Loretta Mester have been a hawk, but they both have said that they don't necessarily think we're going to need interest rates to rise anymore. So they've at least come to the neutral zone. The question is, will they accept the idea of rate cuts? And I suspect that's going to depend on the data between now and the March meeting, now and the May meeting. At some point, you have to go with what the data are telling you, even if you were afraid that you were going to have to raise rates earlier.
Are you surprised, Mike, that no one asked about the New York Community Bank issue and how much they do have confidence that the regional banks truly are in a good spot?
Well, I think the fact that they took the strength of the banking system part out of the statement was a mere coincidence, because the statement would have been drafted yesterday and circulated among them. And of course, they didn't know anything about New York Community Bank at that point. But I think the reason it didn't really come up is because think about what happened to New York Community Bank. They lost money in a quarter, and stock investors jumped on that because they don't like to lose money. This wasn't a question of a bank going out of business like SVB, which New York Community Bank bought their loans, and that's one of the reasons they had problems. So it doesn't suggest that there's any kind of systemic problem in the banking system like we were worried about last March.
Hey, Mike, thanks for the update. Great work. Mike McKee, out there down in Washington, D.C., just coming out of that news conference with Chairman Powell. Equities, TK, near session lows, we're down about 1.5% on the S&P.
I've got greater confidence that Microsoft hit a yearly high yesterday. You know, the market's off, and I really don't know what to make about it. The real yield came back nicely, gyrating off the nominal 10-year yield, 3.99% to me. And Lisa, this goes to your concern over the banking system and other properties in New York City that are really coming under, you know, individual properties coming under pressure. The fact is the 10-year yield's under 4%. That's a real adjustment here. And it's the uncertainty that's out there. And maybe that's what, in the Eccles Building meeting, maybe that's what they were concerned about, the timidity of it.
Although, to me, it seems like he wasn't that concerned about that much, to be completely honest. It's just that he didn't want to get it wrong, and he didn't want to get it wrong on either side, but certainly with the strength also, as you pointed out. The fact that he did indicate that March was off the table, despite some of the signs that people were using to justify it, was significant for the market, and is the reason why we're seeing the market move on that.
We talk, he manages money. Joining us now, Jeffrey Rosenberg from BlackRock. Really, really interesting here on Wither and Forward. How does your view adjust, Jeff? I was thunderstruck by the timidity, the massive, almost comedy on the word data. And you got to go out and run a portfolio. How do you do that given what we observed today?
So, Tom, you're talking about the timidity, and it's in the context where the last two meetings was the opposite from the chairman. There was a lot of confidence.
Yeah.
I'd characterize it as a little bit of a victory lap. He leaned into the positivity. He leaned into the good news. And here, I think it began with the statement, the inclusion of the new language around needing to have greater confidence was the sign that they're going to push back a bit against market expectations, and it carried over into the press conference. Wasn't clear whether that would happen. It clearly did happen, and it's capped off with this headline that is absolutely the headline takeaway, which is the pushback. Hard pushback against the March expectations. And I chalk this timidity up, Tom, to the concern around financial conditions doing too much easing for them and putting at risk the good story that they're having in terms of inflation getting back down to target and right. Growth holding up and not having to have that big decline that Lisa was mentioning that they were warning of, that we thought was going to be necessary to get that inflation down. So it's the risk of losing financial conditions, and markets are just primed for the big green light to go out and back up the truck, and obviously they're disappointed on that today. I think that's a little bit purposeful.
Jeff Rosenberg, Jason Furman up at Harvard teaching Act 10 with my tweet of the day. I love his single sentence observation. I feel like I could be confident enough after two more jobs CPI prints. May I suggest that Friday at 8:30, we and the chairman will readjust?
Yeah, I mean, look, he wants to delay here, and there was something that he said that I think hasn't been picked up on, which is the decision to begin cutting is of great consequence. And then he also said earlier, because of that, or because of that concern, there's no need to rush. So waiting for more data and kind of the pushback on what more data do you need isn't really the story here. I don't think they need more data. He kind of said that. We have confidence. We just want even more confidence. I really think it's they don't want to rush into it. Jonathan Ferro, you asked me after the last payrolls, what is my expectation? I said, June, mainly because I don't see the rush here. And I think that's the story. Is it May? Is it June? It's not March. It's pushing back because they don't want to rush into a cutting cycle.
You said something really interesting there, Jeff, this idea of financial conditions being a concern, that they see the sort of golden pathway and they want to get there so bad that they don't want to disrupt it by giving any more fuel to this market. Do you get that sense, just in general, that if things sort of stay subdued for a bit longer, that'll actually make it easier for the Fed to cut sooner?
Well, the thing that will make it easier for the Fed to cut sooner, and I think Bill Dudley highlighted this, is that the problem is that there's a little bit too much good news on the economic growth side and the labor market side. If they had some weakening, that would make it much easier to say, now we need to cut. It's hard to say you need to cut, and we'll talk about this on Friday morning. The expectations around, 265, 280, that's a pretty gangbuster payroll print. Hardly the kind of stuff that says this Fed is too tight. And you saw it in Steve Leisman's question, and I think it will emergingly become a greater focus. Which is on the growth side.
Yeah.
Like, where is the restrictiveness of this policy that you're so confident every time you say policy is restrictive? Is it really as restrictive as we think?
Yeah, Steve Leisman always with some smart questions. Jon Ferro, let's go to the statistics for Friday. I got 185,000 on survey non-farm payrolls. I got an unemployment rate of 3.8%. That may have a little bit to do with their timidity.
Yeah, I think that speaks to the nervousness. So, Jeff, let's finish on this. Data still looks okay. Payrolls might change that on Friday. For you right now, in this market, putting money to work, what are you advocating for?
I think there's a lot of hemming and hawing today, tomorrow, around the timing of when do they go. But I think if you take a step back from this inside baseball story, the broader story is the Fed has won the battle on inflation. Not totally certain, where we settle in there, but certainly they can begin a cutting cycle. And the growth side is much more positive than what we had thought, particularly when we thought that interest rate sensitivity was going to be greater and recession much more likely. So I think this is a backdrop that is unchanged for taking on more risk in portfolios. It's a better outlook. The credit markets, despite some of the news today in terms of the banking sector, that's particular to commercial real estate. And that is something I think we have to keep an eye on. But you look at the corporate side, you look at the consumer side, it's very strong. And the credit markets here, I think, are strong. There's not a huge price appreciation opportunity, but I think the yield opportunity that you can capture there without the risk of the downside of of recession is still the story here.
Hey, Jeff, thank you, sir. I know we're going to do this again later this week, so we'll see you Friday after payrolls. Jeff Rosenberg there of BlackRock. Thank you, buddy. Equities near session lows. We're down 1.5% on the S&P. We're down hard on the Nasdaq as well. TK in the bond market. The move fades just a little bit. Yields are lower by 8 basis points at the front end of the curve.
We're going to get through the tech juggernauts. You mentioned it, John. We've got Amazon, I believe, and Apple tomorrow, maybe even Facebook. And the answer is, we're going to get some tech earnings, some tech joy. But Lisa, I'm sorry, to Jason Furman's comment here, the jobs report on Friday has a new importance.
So maybe if it gets strong enough, then everybody will go back to maybe, going to June. And if it's
I think
weak,
you missed what just happened here. I confuse him with Jason Furman as well. Yeah, I do too. Jeff Rosenberg.
No, I'm talking about Jason Furman at Harvard and his jobs matter here.
I confuse them both. Don't they look the same?
They don't look the same.
I confuse them too. No, they look the same.
I'm going to suggest, John, this jobs report is now really important.
Not all economists look the same, John.
We should do this again.
Yeah, we should.
March 20th. How much do we have to pay you to wake up earlier?
I don't know. Talk to my people.